Hello, babe. What's up? Any news?
Yes, so they've reduced the fee for that project management course from 100k to 20k. But we need to pay today to take advantage of the price slash. I'm about to make my own payment too.
Oh, wow. So the deal is just for today?
Yes, I'd have asked you to send me your own money, but anybody that knows you knows that you are Mama Investments. All your money is probably in investments, and it will take like 1 million days for you to withdraw and send to me.
Mama investments. A girl has to make more money. And AXA Mansard investment gives me all of that. Anyway, I have sent my own money. Just go and make your own payment too.
Wait, what? Now? Should you said all your money is in investments?
Yup. With my AXA Mansard Money Market Fund account, I can do transactions fast and earn on the go. And if I want to invest in other portfolios, I do not have to leave my AXA Mansard platform. They offer me a one-stop shop that gives me a wide range of investment options. That's why I'm called my investment now.
Transact, earn, go with AXA Mansard Investments. Visit www.axamansard.com/investments or dial *987*2# to get started today.
Hello, babe. What's up? Any news?
Yes, so they've reduced the fee for that project management course from 100k to 20k. But we need to pay today to take advantage of the price slash. I'm about to make my own payment too.
Oh, wow. So the deal is just for today?
Yes, I'd have asked you to send me your own money, but anybody that knows you knows that you are Mama Investments. All your money is probably in investments, and it will take like 1 million days for you to withdraw and send to me.
Mama investments. A girl has to make more money. And AXA Mansard investment gives me all of that. Anyway, I have sent my own money. Just go and make your own payment too.
Wait, what? Now? Should you said all your money is in investments?
Yup. With my AXA Mansard Money Market Fund account, I can do transactions fast and earn on the go. And if I want to invest in other portfolios, I do not have to leave my AXA Mansard platform. They offer me a one-stop shop that gives me a wide range of investment options. That's why I'm called my investment now.
Transact, earn, go with AXA Mansard Investments. Visit www.axamansard.com/investments or dial *987*2# to get started today.
All right. Good afternoon, everyone. Good afternoon. I trust everybody is well this afternoon. Welcome to the 5th edition of our Achieve Much More webinar. I see a few people are already in. So thank you for joining. Thank you for joining early. Call your friends, call your family, send them the link, let them join as well, because this is going to be a great session. Are you still able to see my slide? Okay, fantastic. So once again, welcome. Today we're talking about a very, very important topic, investing smart. Investing smart. We're going to talk about a lot of strategies that we can use to invest smart and build wealth. So welcome, and thank you for joining us. All right, so in this session, we'll quickly go into the ground rules to make sure that we're all on the same page, after which we will go into the meat of the matter, which is the presentation for today from our guest speaker. Then we will have a Q&A session, and then we will take quick closing remarks after that. It's going to be short, but very, very impactful. So please make sure your internet is great. Make sure that you are somewhere where you can hear us and see clearly, because there is a lot of information that's going to come out from today's webinar. Make sure you have great internet connection so that you don't miss anything. The second thing is to please make sure mics and cameras are off during the presentations. I'm sure that already the settings for the presentation is that the mics and cameras are off during the presentations. But should you get the opportunity to put on your camera or to put on your microphone, please don't, to ensure that we have a smooth flow and we don't distract from the presentation. There will be a Q&A session after the presentation, so don't worry. Your questions, your concerns, your comments will be taken at the end of the presentation, and the guest speaker will be here to answer them all. You can use the chat session to drop your comments and to drop your questions as we go. So let's now move into the right, let's move to the meat of the matter. Let's quickly introduce our guest speaker, Progress Felix, a portfolio manager at Mansard Investments. He has over 3 years experience in securities trading, investor relations, fixed income strategy, and macroeconomic analysis. He has a BSc in building from Federal University of Technology, Owerri. Progress, are you there?
Yes, yes, I am. Yes, I am. Good afternoon. Good
right.
afternoon, everybody.
Okay, welcome, and you can now go ahead with your presentation.
All right, all right. Thank you for the introduction, MEMC, and good afternoon to everybody on the call. So today will be conversations around building wealth and investing smart. I think a number of people have heard a number of things about how to grow their wealth, what to do with money. And today's conversations will largely just be to cement some of the things that you know already, some of the things that you've heard, and as much as possible debunk a few of the couple other things that might not be in line with what is obtainable. Yes, and we'll be running through a couple of these conversations on this deck. Next slide, please. Let me see. Yes, and this would just be the meat of the matter in terms of our discourse today. Just have a couple of context to run us through. We'll be going from financial planning, giving some bit of context to what's the prevailing investment behavior at the moment in the current Nigerian landscape. What really is the major context at the moment, and where is the economy at? Basically, getting to know this helps you position your investment options a bit more deliberately, knowing where the economy is at, where the economy is headed, and most importantly, trying to create a financial plan around most of these projections and actual figures in terms of macroeconomic indicators. Like is usually said, you definitely will need a plan to be able to achieve victory. So we'll also touch on some financial plans that we can map out as individuals to drive our investment objectives. I would drill that down a bit more. I'll talk about strategies that will underpin some of these plans. Basically, that would be what our conversation would be for today. And let's dive into the meat of it. Yemisi, next slide, please. Yep, next slide. All right, fantastic. What you have on your screen might be information that might not be totally new, but is something that is worth pondering about. So we'll just take the first one. In Nigeria, over 70% of adults do not invest in formal investment products. This might look far-fetched, but again, data would most likely communicate truer pictures. Over 7% of Nigerian adults do not invest in formal investment products. And honestly, why is this? There is that there's that form of averseness for the average Nigerian, and there's also that information gap. Not a lot of people are well informed in terms of investment products, but in the past couple of years, we've seen that gap continue to bridge. We've seen that gap continue to narrow. There's been some level of bridge in covering that gap, and this number has been improving, just to mention, but most recent data suggests that a huge number of adults do not actively invest in the formal, do not actively invest in formal investment products. And this just goes to say there's a lot of money being left on the table. There are lots of opportunities that go without being noticed. A few percentage of people out there have this right information and they are able to action on them, and really that's really the difference between the doers and those that watch others do. Again, the second point here, most Nigerians save less than 10% of their income, far below the recommended 15 to 25%. Again, this is like the reality of the average Nigerian. Liabilities far outweigh their assets, their spending habits supersedes their saving habits. Disposable income narrows way too quickly, and by and large, the average Nigerian saves way less for minimum income of about near 77,000 naira. A lot of people can barely survive on that, and saving 10% of that might not be very feasible, which just further buttresses the second point around Nigeria saving less than 10%. Again, this is just giving you a context to what the reality of the average Nigerian is, so that you can put in better perspective the quality of information that you are receiving today, and not just receiving these informations, but being able to action them and take decisive directions towards actualizing your investment objectives. And just quickly run through the rest. Investing early and consistently, even small amounts, is key to growing long-term wealth. Again, I think this needs no further explanation. There's the myth around making it big, making it quick, but what the data has been able to show in recent times, and even in extended periods of time, is that investing early would most likely is most likely a stronger strategy in terms of growing long-term wealth than perhaps just attempting to time the market or invest large sum at a particular point in time. So maybe just to buttress this, an individual that has been saving, that probably started saving at 25 and saves a minimum of, say, 50K on a monthly basis, as benign as that amount might want to look, if that individual keeps a consistent practice of saving 50K every month, and he invests that 50K in an investment vehicle that yields something around 10% on a monthly, on an annual basis. By the end of 20 years, that individual most likely have somewhere close to 35 million, investing 50K monthly in an investment vehicle that yields at least 10% per annum. On a 20-year horizon, that individual should have about 35 million. And if you shrink that time to, say, 10 years, that number significantly shrinks, which just alludes to the fact that investing early and then consistently would most likely be a more reliable strategy in terms of long-term wealth creation for any individual. And again, the best return comes not from time in the market, but time in the market. Again, these two statements go pari passu. As I previously stated, there is the belief to always want to time the market. Is this the good time to to buy? Exactly. I get that question almost every now and again. Is now a good time to buy? Should I be buying now? Honestly, if you're a long only investor, I think the best time to buy is that time that you're speaking. Except probably you're actively trading the market. But the point still remains that the best return most likely come from your time in the market. Like I did say earlier on, um, investing early and consistently, that time factor affords you some level of opportunity to earn consistently from the market over just attempting to time the market. Again, this is just to provide a bit of context on the average, on the reality of the average Nigerian, and know how to better position above this average reality. Next slide, GMC. Hi, MEC, can you hear me? Please, next slide.
Okay. High progress. I'm just going to be in. Okay, because it seems the network was a bit. Can you see it now?
Yeah.
It's coming up. Yes, I can. Yes, I can.
Okay.
Would want to have that on presentation mode. All right, fantastic. Yeah, so like I did mention during the start, we would basically be looking at the average reality of the Nigerian, and again looking at what really is the economy saying in the country. What are those major indices that define economic growth and performance for the country? And we just had a quick hand pick um, of major macro indicators in the country that would most likely provide direction in terms of where the economy is headed and how we can plan around some of these indicators in making certain financial decisions. Crude oil production, we see that up from last year. Last year, we had crude oil at 1.53 million barrels per day. Figures from August show 1.63 million barrels per day. This is good for Nigeria. I think we all know that Nigeria is a major source of our USD, a major source of our exports is hinged on crude oil production. And seeing that the numbers are trending higher should signal some level of economic growth for the country. If where you are earning money from continues to earn you more money, then it signals some level of confidence in the economy as it were. And when you look at headline inflation at 20.12 in the month of August 25. When you compare that with August 2024, inflation was at 32.15%. And maybe just for a bit of context, a number of things had happened in the country that has driven the numbers this low in terms of where headline inflation closed in the month of August, much of which where we saw a bit of action from the central bank in terms of the attempts to cushion in terms of their strategy to cushion inflation, more like battle inflation. And then we saw the MBS take on some rebasing during the start of the year. Much of this did filter into the disinflationary trend that we've seen in recent times. So August inflation at 20.12% as against 32.15% in the month of August. That shows that inflation is not that is tapering, meaning that it is reducing, for lack of a better word, and which means that for the average consumer, it means that on a year basis, it means that you got things slightly less expensive over the previous period. And in terms of GDP growth for Q2, we did see that come at 4.23%. This is a more recent data. And again, much of this was hinged on the activity of the MBS in terms of their rebasing exercise we saw during the start of the year. When you look at sectors supporting growth within the country, the financial services, the insurance sector, we see some performance from the agricultural sector as well. And when we look at where currency is, I think this is one where I think a lot of us would have a lot of view on. Last year, August 24, we saw the naira against the dollar at 15.98, and this at the official window. We saw at parallel market almost to 1.6 levels. But as at September, this past week, the naira against the dollar traded at 14.87 against the dollar. Much of this has been on the back of the attempts by the central bank to, as much as possible, provide some level of confidence to the market, and in that vein, attempt to help the market see the true value of the naira as well. Much other actions have been taken by other players in the market, and that has helped to further strengthen the naira. Market players like the IOCs, the FPIs, we've seen a bit of interest from them, and then you notice that our crude oil production has been inching higher, meaning that we've been getting some form of effects from that direction as well, and we've seen improved remittances. That's your guys abroad, for lack of better word here. We've seen improved remittances. Much of this has helped supply of the USD at the disposal of the central bank. Again, all of this also reflected the FX reserve compared to same time last year in the month of August 2024. FX reserve was at $36 billion, but as at August last year, we saw as at August this year, coming into September, FX reserve stood at 42.13 billion. Again, I alluded to some of the drivers that have contributed to this. We've seen improved remittances. We've seen flows in terms of crude oil production, in terms of flows we get from crude oil. We've seen other activities. Basically impacting FX for the country. Monetary policy, at the last MPC meeting, I think sometime this week, we saw a rate cut by the MPC by 50 basis points to bring it to about 27%. And then the action by the MPC to reduce interest rate signals that perhaps much of the action that have been previously taken has been able to yield some positive results, and hence the direction to cut interest rates. What does all of this mean to the average individual on the road, to the passerby, to the average Nigerian on the streets? Let's just go to the next slide, then we'll harmonize all of these many informations. Next slide, please. Yes, this chart, forgive that it looks very scary. No, the previous slide. So we just combine all of the macro information so we can get on with it. So this slide just shows the interplay between policy rates, inflation, and where your treasury bill rates have been trending. You notice that you notice that major dip in terms of where inflation was and where your treasury bill was sometime in January, and that shows some bit of harmonization harmonization between your treasury bill rates and then inflation figures. Sometime in January, you see the chart show MBS rebasing, and we saw that major dip during the start of the year. And before that, you see some aggressive positioning by the central bank from December 2023 you see that inch up to the later part of 2024, as you see MPR move from 18.75% to about 27.5% at the later part of 2024. All of these were actions that the central bank had attempted to take in their battle against inflation, and you see that yield some level of results as they held policy rate steady, and much of that did translate to some downward trend in inflation, and then your yields did follow suit. So what does this mean for the average Nigerian? It simply means with the 50 basis cut in MPR, it means that companies and businesses might get interest rates at perhaps lower rates, meaning that there will be lower borrowing costs for businesses. And then what does that mean to the individual that keeps his money in the savings account? Simply means that you might be getting lesser from your savings account in terms of the interest paid on a monthly or quarterly basis. Yeah, so that just shows a bit of overview in terms of economic macro snapshot. Next slide, please. Next slide.
Hi, Progress. Okay. Can you see it now?
Yes, I can. Yes, I can. Yes. So we just made an attempt towards projecting some of the macro indicators over multi-year period, just to show us where some of these indicators had been from over a multi-year period. You see GDP continue to swing from all-time high, touching even the negative territory, and then currently at circa 3% levels. We anticipate that the GDP for the country should steady at above 3% levels going into next year, which is a good average in terms of good for the country. And also in terms of headline inflation, we have the opinion from the chart to see that inflation should trend lower, and then on the back of that, we anticipate that the CBN should cut rates even lower. And then from a projection standpoint, we anticipate that by 2026, we should see interest rates somewhere closer, somewhere closer to the 10% levels. In terms of where we have what our views are in terms of FX reserve and performance of the naira against the dollar. In terms of FX reserve, we have the opinion that we should see the FX reserve inch closer above the 40 billion mark, for which we've already seen that register prior to now. By the end of December going into next year, with most of the assumptions still panning out, we have the view that the FX reserve should continue to bolster at current trend. All of this does matter because it's definitely going to help in terms of your investment projections and positioning, as well as your overall strategy as an individual towards your objectives. Next slide, please. Yes. All right. So we'll just go straight to the meat of the matter. We'll begin with building a financial plan, but then before we do that, we need to be able to dimension our risk levels in terms of building blocks for informed risk profile. A number of a number of indices on the screen in terms of what to look out for from the standpoint of risks, in terms of what you're able to in terms of risks. Basically, there are a number of characteristics that needs to be looked out for in terms of dimensioning what your willingness and your capacity is in terms of taking certain risk level. You have that on the screen, but just to drive that home a bit more. So we just have like two case scenarios. Say you have a 25-year-old entry level graduate trainee that has probably gotten a job in one of the banks, probably earns, for the purpose of this example again, and probably earns, say, like 400K. He lives with his parents. He's not paying house rent. And then for that individual, you see that to be able to dimension this properly from the standpoint of age, he does have time. Investment experience, maybe not so much investment experience. Is he an employer or an employee? Is obviously an employee. His time horizon might be longer depending on what he's invested at. His time horizon may be longer because he's younger. In terms of current investment, his net worth, maybe not so much since he's just starting out. His life stage, what phase of life is he currently in? Probably just at the early phase of his life. What is his maximum loss? Well, he stays with his family, probably still enjoys some privileges, so he might be open to some level of loss positions. His liquidity consideration, how much cash does he need per time, and whatnot. Him having for this 25-year-old, he needs to be able to dimension all of these characteristics to properly define what his level of risk is in terms of his tolerance for risks, his willingness or ability to take those risks. And if you flip that and maybe have a 45-year-old experienced manager wanting to take an investment position, again, the age is different. His age is different. He might possibly have some investment experience. Maybe he had done a bit of investment here and there. Is he an employer or an employee? That means that is he looking to pay people by the end of the month, or is he receiving a salary? Does he run a business? How frequent is that? How frequent does he get cash flow from the business? His time horizon, again, he might not, the 25-year-old might have 30 years investment horizon, might be saving for his 50s, but then the 45-year-old individual might not have so much of a time horizon on his side. Again, all of this would impact the level of risks the individual is able to take. Are there any unique circumstances? Perhaps in his company he has some stock options, so he might not want to buy the stock of that same company at the open market. His liquidity consideration, probably his children are in school already, and so he probably needs some form of liquidity to offset the children's school fees within certain periods. So all of this information would come in very handy for different individuals to be able to properly profile themselves in terms of what their risk appetite is, how tolerable are they in terms of risks, what they are willing to take, what they are open to taking, and basically that would help situate the kind of investment strategies that they would want to pursue. Next slide, please. Yes. So building a financial plan, that we have a four-step approach. We began with attempting to give meaning to what the risk appetite of the investor would be, what your risk appetite would be. And we mentioned a couple of things in the previous slide. And then the outcome of that exercise will be that you come to this financial plan that we have outlined here. And we said you begin with setting goals, and setting goals really, what do you want? When do you want it? And at what estimated cost? As basic as this question sound, when we drill down into them, they may unveil to us certain information that would be very instrumental in drafting our investment strategies. So what do you want? Are you looking to Are you looking to have a retirement fund that is worth 100 million when you're done? That's for that 25-year-old person. Maybe you're just starting out your career. Maybe you want to have 100 million naira investment that you would use to retire. And so for that person, that is what they want, and that is what they have considered the goal. When do you want to do it? Meaning that, do you think you will start now? Do you think you will start maybe when you are middle management, or do you think that you will start when you are almost ending the career? You need to decide when you will do that and at what estimated cost. What will you be able to do? To be able to achieve that at what cost? So for the individual that probably at 25, starting out his career, he wants to have a retirement fund of say 100 million, and he wants to start immediately. So that is him answering question one and question two. At what cost we do want to do that? So he says to himself, if I can invest in an investment vehicle that yields a 10% annual return, that means I would need to save at least 100K every month for the next 20 years, and I should have close to 100 million by the end of 20 years. So he has been able to dimension what he wants. That is an investment that will serve as a retirement plan. And when he wants to do it, he has proposed that he would do that immediately since he just got a job offer. And at what cost? He has decided that a monthly savings of 100K in an investment vehicle that yields 10% per annum over a 20-year horizon will earn him 100 million at the end of 20 years. As basic as this is, this does help dimension your investment strategies. Again, to the next point, controlling your spendings. Review spendings against benchmark, set a budget and customize it to your situation or style. Again, you can't invest much if what you spend outweighs what you earn. That's the oldest rule in the book, I guess. So controlling your spending, you need to be able to review your spending. I think there are a number of rule of thumb. I think there's the 50-30-20 rule. You spend 50, save 30, invest 20. So you need to be able to dimension per time that of my total earnings, how much goes into spending and what exactly do I spend my money on. I think the average Nigerian would spend most of their money on feeding and transportation. But again, you need to find a way to ensure that whatever spendings that leave your earnings, you find the most optimal way to reduce that, to be able to match your situation. And that's what the point two is saying. Put a plan together. Again, once you have decided what you want to do, you set your goal, you've been able to dimension your spendings in terms of what you earn and what you're able to and basically your outflows. You need to put a plan together. Putting a plan together, it means that you need to be able to understand what your required returns are, your tax consideration, your risk tolerance, your time horizon, your liquidity needs, all of the things I previously mentioned in the last slide. Again, I'll be using this as an example a bit more frequently. For the 25-year-old that wants a retirement fund, he needs to know that saving 100K per month at a required rate of return lower than 10% might not earn him 100 million in 20 years. So he needs to understand what his required return is for him to get 100 million in 20 years. And then his risk tolerance is he willing and able to take some level of risk? Is he scared that he will lose his money? At what point at what point would he be able to accept certain level of risk to earn certain level of return? All of this would play out in his choices of instruments, in the choices of investment vehicles that would help him achieve his investment objectives of 100 million retirement fund. Again, his time horizon, might be 20 years, but for another individual that's probably like 45 years old and maybe already rolling out into retirement might not have such time horizon. And for that individual, he might need to save a bit more, and he might require a slightly higher required rate of return to be able to achieve similar 100 million retirement fund. And liquidity needs, like I did mention as well, the 25-year-old might not have a lot of liquidity needs as compared to a 45-year-old. And again, this is all else being equal. And you're making the assumption that maybe the 25-year-old is single, just starting out, while the 45-year-old had probably a bit of more responsibility to take. And putting a plan together would also mean, I think there is an acronym we have here. We have save, invest, and insure. Again, in terms of saving, you look at the previous slide. Not the previous slide. You look at controlling your spending, where you have the 50-30-20 rule, where you save 30% of your earnings, and the goal of that is to have that in an emergency fund. And the entire goal of the emergency fund is such that you're able to maintain some level of stability while you also invest, such that certain emergencies do not throw your investment plans off track significantly. So we typically recommend a 3 to 6 months of expenses for you to have as your emergency fund. What that means is that on a monthly basis, if your total expense that you incur, maybe running your typical day-to-day activities, transport, food, data, clothing, whatever, probably amounts to 200K for ease of example, 200K, then we are saying that you should have somewhere between 600 and 1.2 million as your emergency fund. That will be able to cushion whatever emergency drops in at any point in time. Again, you build this fund systematically and gradually, and that's how we arrive there. In terms of invest, let your money work hard towards your key goals. Again, it's not just enough that you save some of these funds. It is more prudent that you invest some of this fund in varied investment vehicles that could help your money do much more for you than just sit in your bank account. And that's how you're able to drive your investment goals through investing. And lastly, in terms of putting a plan together, you get to insure. And by insuring, why investment means that you are trying to capitalize on the upside, meaning you want to grow your money. Investing will mean that you are protecting against the downside. In case the phone gets stolen, would I need to save all over again to get the same phone? It means that I've not done the last part. I've not insured it. If a particular loss would mean that would equate an erosion of all of my investments, it means that I'm not done the last part properly. And part of putting a plan together is that as you've committed to creating an emergency fund, you're investing your money, it's only prudent that you insure them as well, and insurance is protecting what matters. And again, at every now and again, it is advisable that you review all of these plans, so that you know when you're off track, you know when you're on track, you know what to do to be back on track, you know how to double down just in case you need to just in case you feel you are far away from the initial plan, how you need to double down and achieve those plans. And again, we'll recommend that you do this as frequently as you can, perhaps on a monthly basis, maybe on a quarterly basis, but as frequently as you can, just so that you're able to track whether you are still in line with the initial plan and how close or far you are from hitting your financial goals and objective. Next slide, please. Next slide, please. Yes, investment strategy, the smart investing framework. And this does not follow any particular order. this does not follow any particular order, I must say. But just to put that out, S is strategy. You need to define goals and timelines. Goals and timelines are very key in the investment universe. Like I did mention during the start of this, that your time in the market would most likely outweigh your attempts to time the market. So you need to provide key timelines. When are you going to begin? We saw that in previous slide. At what point, at what periodicity, at what intervals, for lack of better word, would you be making these investments to achieve your goals? You need to be able to define that. The aim will be to manage your risk. Knowing what your risk tolerance is in terms of your ability to take risk, in terms of your ability to in terms of your ability to take risks, in terms of your willingness to take risks, you're understanding that, oh, I like it when, or I don't like it when my money goes down. I always want to see my capital, as long as my capital is safe. If you know you are an investor that is more keen around capital preservation, you want your capital safe all the time, but then you also want to take a bit of risk so that you can maximize your return. What you need to do is you need to be able to diversify that risk, and then diversification basically is just you attempting to spread that investment across multiple asset classes so that you're able to mute the extent of the risks you are holding. Meaning that rather than have all my money in equities, what if I have some of them in money markets and I have some of them in equities? What if instead of keeping all my money in real estate that is not very liquid, what if I have some in real estate and then have some in bonds and then have some in equities? That way you're able to diversify that risk across the different asset classes. That's what M really means. A are your assets. What is your investment universe? What are you able to invest in? Are you able to invest in equities, bonds, real estate? Alternatives. Alternatives would just typically mean your non-traditional assets, which will be things like commodity. I think that's a more popular one for non-financial professionals. So your asset universe really. Equities will just mean you're trying to buy ownership stakes in the company. You like a particular company, you feel like they are doing great. Maybe you like the CEO, although these are not very good rationales to buy them. But again, the point is knowing what your investment universe is, what you're able to invest in. I know some certain people are not able to invest in certain instruments because of cultural and religious beliefs. So basically knowing what your investment universe is, the assets that are open to you to take exposures in. And again, your returns, that's R, your returns really. Are you an investor that say, oh, as long as my money is safe, just give me 10%, or you're the investor that say, oh, take some risks with this money, I want 50%. That kind of scenario. So basically knowing what your returns are, what the cost will be, the fees, the tax implication, what inflation would be. Inflation matters here because certain investments offer positive real return, meaning that from a risk, from an inflation adjusted standpoint, the investor still gets some real return from that investment. So you need to be able to dimension what your returns are. And again, all of these are not they are not just in silos. They really do are interwoven really, because from your strategy you can outline what your returns will be, because your strategy will not want to be from your strategy, you may not want to be a capital preservative investor and then you say you must get a positive real adjusted return. It might not really align. Just also put that out there. And from your assets universe, you might not say, no, all I want is just money market instruments. And then when inflation start going lower, you start asking, why is my money market going lower as well? That's because you've not properly managed the risks associated with investing in money market type instruments, because your investment universe has not allowed you to explore other investment classes. And then T would represent your patience and consistency in the market. I think I've said this one too many times on this call, that your time in the markets would most likely outweigh your ability to time the markets in terms of your eventual return during the period. Again, just to speak to these asset classes, I think we've overstressed on that. Money market instruments are just instruments that have less than 1 year to maturity. They are low risk, short term. Examples are your treasury bills. Treasury bills are debt instruments issued by the government that are less than 1 year maturity. Your commercial paper are the flip side of that, or the corporate, on the corporate end. So your commercial papers are like treasury bills being issued by corporates. And again, your fixed deposits, the ones you have the banks, the ones you have your asset managers, all of those fall within your money market instruments. Really, much of this is much of this is heavily impacted by where interest rates are. With interest rates declining, most of these assets, most of the returns on these assets would also follow suit. Your fixed income assets are your bonds, whether they are government bonds, corporate bonds. Point is that they offer you a fixed level of interest payment over defined periods of time. We call that coupon, but basically that's what your fixed income assets are, and they can have longer term to maturities. That you can have a bond of like 2 years, between 2 years, like up to like 30 years. That's on the fixed income end. And the equities, I think I didn't mention that. Basically just having ownership stakes in companies, and basically when you do that, you are a bit more risky in your investment, because you are not just seeking capital preservation, but you are also keen on capital appreciation. Equities will be your common equities, that's different shares of different companies, your ETFs as well. Just had to say that just so that we're able to situate all of these things I mentioned on this slide together. Your strategy will most likely filter into what your return and asset universe will most likely look like. The ability to manage risks would also be reflective in your consistency in the market, and also filter into the kind of assets you have in your assets, in your investment universe. Next slide, please. Next slide, please. Okay, very fantastic. So we have mentioned a number of things, and just to recap, we talked about risk, trying to dimension what your risks are in terms of your willingness and ability to take on those risks, what your risk tolerance are. We mentioned a couple of indices to look out for, and then we also looked at what your first step plans are in terms of financial planning, and looked at your SMART framework. And on this slide, we'll just try to put all of those pieces together and be a bit more pragmatic and hands down in terms of what actions we would recommend that you should be taking. And then we'll drill that down into 3 scenarios, really. So the first scenario is a conservative investor, and this investor's risk profile is that he's conservative, meaning I don't want any 10 kobo of my money to miss. This money now I'm giving you is just for 1 year. Nothing should do this money, please. That kind of investor. And I'm trying to be very nimble in my explanation of what this really means. So what we would advise for an investor of this nature, that's a conservative investor, meaning your time to maturity, your time horizon is just 1 year. You just have this money to invest for 1 year. Would say let much of that fund sit in money market type instruments, about 30% of that. You can rotate it around. You can keep that around 20% above 30%, meaning that you can decide to do either 50% or do as low as 10% of your monies, and then keep them in dollar bond fund as well. And the rationale for recommending dollar bond fund is that we've observed that over a multi-year period, assets that sort of like incorporate USDs in their portfolio mix sort of like outperform over portfolios that just have Naira in them. And really, that observation has been has revealed that portfolios that have USD mix in them will most likely um, outperform portfolios that are just Naira denominated. And really much of that is was largely attributed to the performance of the Naira against the dollar in terms of valuation gains that those portfolios might enjoy over just Naira denominated portfolios. And on the back of that, that has also strengthened our own recommendations here. And you see that in the risk profiling here. So we recommend that you have somewhere between 30 to 50% of that money in money market instruments, money market fund, and then you have about 5% in equities. So if you have 100K, maybe you have 65% in USD, another 30% in money market, and 5% of that in your equity income fund. But if you are willing to take on a bit more risk, we call that the balanced portfolio, meaning you have a term horizon of between 3 to 5 years. You can spread that a bit more, take on some more risks to amplify your returns. You can rotate from being just 5% in equities to having somewhere around 40 to 40% in equities, and then have lesser in money market fund. And this is because you are trying to diversify your risk as well as maintain some level of liquidity considerations if need be for the portfolio, and then have that skewed and have the rest skewed towards your dollar bond fund. That's for clients that have a balanced risk profile. But if you are very aggressive and you have a longer term to maturity or a longer term horizon of 7 to 10 years, we recommend that you go a bit more on your equities. If the amount that you have is something you can keep for a bit longer, like the 25-year-old I've been using as an example for the better part of our conversation. The advice would be that he goes longer with equities, have about 75% of that in equities, and then spread that and spread the balance across the dollar fund as well as money market fund. And really, the idea around keeping funds in money market fund for this kind of investor will be to address some level of liquidity concerns, just in case there are needs for some liquidity payout from the portfolio. And that will be all in terms of how would most likely be situating and recommending to clients based on their risk profile and what we feel they should be doing considering current market dynamics and as well as their specific risk profile and time horizon. Next slide, please. Next slide, please. Yes. I think that brings us to the finish line of these conversations. But just so that we're able to put a bit of actions to some of the recommendations that we had given for a number of people that might not be that might find information very useful. In terms of the dollar fund, you'd observe that I'd mentioned that a couple of times. The dollar fund, we currently run a dollar fund in-house. the AXA Mansard Dollar Fund. At the moment, yields about over 6.5% annualized on the portfolio. On the screen, you have key information about the dollar fund. Minimum investable amount is $1,000 into the portfolio. And then more importantly is that we carry out a quarterly dividend distribution for the fund. And this fund basically offers you the ability to have exposures on the USD front. Like I did mention, we have observed that portfolios with a bit of USD mix would outperform just Naira portfolios over a multi-year period. And this product does offer you the opportunity to be able to have that USD exposure rather than just have the money sit in your dorm accounts where you earn next to nothing, or have them in cash where they do almost nothing for you. This fund offers you that opportunity to earn to make the money work for you, really. And what's the dollar bond fund? Basically, it's just a mutual fund that is designed for balanced risk profile kind of clients, mid-risk tolerance. And basically, the investment objective for the fund is deliver steady dollar income to investors and help them optimize their returns on their FX positions. That will be all for the dollar fund. And then the money market fund, I think that should be the next slide. Let me see if you'll be kind enough. The money market fund is just, okay, we have the equity income fund here before the money market, but the equity income fund is a mutual fund as well, where it's a mutual fund that offers you the opportunity to be able to invest in a basket of common shares. Really, we get this question every now and again. Where should I invest in? Where should I put my money in? What stock would you recommend? Which company should I be buying? Well, if you would not want to bother yourself so much in terms of having those direct exposures, the equity income fund offers you the opportunity to invest in a mutual fund that invests in some of these securities. And from a risk diversification standpoint, it helps you diversify your risks to some of these names, some of these companies, such that the underperformance or overperformance in one stock does not negatively impact your overall holding. And just to speak to specifics of the equity income fund, it's basically for investors that are a bit aggressive in terms of their risk, willing to take on a bit more risk rather than a bit more risk in terms of having capital appreciation over just capital preservation. And it is denominated in Naira, meaning that the portfolio is denominated in Naira, meaning that we invest in Nigerian stocks for the portfolio. At the moment, the portfolio is at circa 25% on a year-to-date basis in terms of return, and that is at the moment higher than inflation. So, which means that if you had invested in the equity income fund at the start of the year, as at yesterday, your return would be a real return of somewhere above 5%, meaning you are beating inflation by investing in the equity income fund. Key features of the fund are highlighted on your screen. And just to speak to the money market fund before we call it a wrap, and then we take questions. Yeah, most definitely. And then the money market fund, I think this is the most popular in my opinion. Basically, it's also a mutual fund that helps you invest in some money market type instruments. A lot of the money market instruments might be capital intensive for a number of people. Treasury bills, your typical FDs might run into millions as minimum investment amounts, but your minimum investment amount for your money market is about 5,000, naira, which is way lower than having direct exposures to other money market type instruments. And it does offer investment returns way higher than just having those money sit in your bank accounts. Money market at the moment currently at above 19.4%, which when compared to typical savings account, um, far exceeds them. It's also denominated in naira, and again, this fund provides capital preservation as against the equity income fund for clients that are a bit averse and would want to prioritize capital preservation over aggressive capital appreciation. The money market fund offers that to them. Liquidation time is around 24 hours, meaning for every amount you inflow, you can get your money back in under 24 hours. And key characteristic for the fund will be that there is a reinvestment that occurs every 3 months on a quarterly basis, where your interest is added back to your principal every 3 months. And in simple terms, we call that compounding, meaning that the money market fund offers you the power of compounding your savings. And we all know what the power of compounding really does. Like the example I stated, saving 100K every month for the next 20 years at in an investment vehicle of that usually at least 10% per annum, you get to 100 million not just by saving it directly. You get to 100 million in 20 years through the power of compounding, and money market does offer that to investors in the fund. I think that should be all on the slides, and we'll take questions now. Let me see. Okay, I think we have key takeaways. Yeah, so just to harmonize all of the things that we mentioned, the first is be clear on your goals for the medium and long term. Again, personal bias, maybe just put that out there. As much as the short term is very important, we must be able to have strategic view on what our long-term investment objectives are, and then be able to properly align what our objectives are with those with that investment horizon. Put yourself on a spending budget using as much creativity. I think we mentioned that again as part of conversations. I will always say you cannot outspend the market, meaning that irrespective of how much you have, when you're done spending, the market will still exist. Meaning that basically meaning that or trying to buttress the point that you have an option to save and be a bit more prudent with your spendings. Right, so that you're able to offer yourself a bit more options. I think that's the entire point of investment. That's the entire point of, in my view, money as well. Basically creating options for yourself. But when you go about not minding your spending budget and not putting them into consideration, you shrink those options as time evolve. And the third one is invest progressively and methodically. Exactly. So we had touched on this, and I think that has been the fulcrum of our entire conversation, where we had outlined how that you need to dimension where you need to invest in, what your investment universe is, what asset classes you'll be investing it in, and basically creating an allocation for your investments in those different asset classes. And then the fourth one, I think we mentioned this should be the last one in the slides around financial planning. We said set a monthly or other frequencies to assess and improve. Basically, when you're done with step 1, 2, and 3, you must have step 4 that you're able to review these processes and see how close you are to achieving these things, see how far you are from the plans you've outlined, and basically rebalance those strategies and actions per time to be able to reflect and help you achieve your eventual investment objective. And I think finally, perhaps even the most important is that you invest in the total, not just invest in your money in an investment vehicle, but invest in your relationships, invest in your health, and invest in your mind as well, just so that you're not attempting to just store money somewhere and then health issues come and erode all of them. So you need to be able to invest in you totally. Yeah. And thank you for the time and the conversations had. EMC, I think over to you now before we have question and answers.
Okay, thank you so much, Progress. Can you hear me? Can you see me?
Yes, I can. Yes, I can.
All right, wonderful. That was a very, very detailed and interesting presentation. But I'm sure you know that people will have questions, and we have quite a number of them. So Wahid Karib says, with the new tax laws in Nigeria, are you going to start paying tax on earnings from MMF? It's an interesting question.
Not at the moment. We don't have that direction yet from the regulator. But at the moment, no. If that does come on board, we'll most likely would definitely inform all unit holders. But at the moment, no.
Okay, fantastic. All right. Taiwo Mayowa said a lot of people are curious about the new tax laws. So it says with the new tax policies in Nigeria by January 2026, how is it going to be advantageous to do MMF? What is the professional advice to us not to be affected much by this tax stuff?
I think we have a lot of task questions. Yeah, let me see. Okay.
Very much so.
Yeah. So in terms of this first question, how is it going to be advantageous to MMF? To a very strong degree, like I previously mentioned in my response to the previous question, that at the moment what you earn from money markets, from the mutual fund, will be on a net basis, meaning after all considerations have been deducted. And again, in terms of what you earn, whether or not they will be taxed, that would be on an individual basis, not from a fund perspective, if you get what I'm trying to say. Yes. So, but at the moment, we don't have any. There are no directions in terms of whether or not we'll be taxed on the money market fund investing in that by January 2026.
Okay.
And to the second question, what is my professional advice not to be affected? I think there needs to be a bit more orientation by maybe the tax office. Or maybe this question is coming from a place of confidence in the tax regime, because it's more like we don't, for lack of a better word, tax should not be seen as a very bad thing. It's more like you're already asking me what our professional advice is not to be affected. It's looking like a stigma. But I think what we can do is to properly dimension our earnings, and then have some of these earnings better reflect what we earn. So let me say that a bit differently. So knowing what the tax laws are and what our obligations are, I think my professional advice would be that we're able to align with those laws, and as much as possible try to ensure that those laws we do not fall prey to them, really. And to be more direct, I think that this advice is not it's not a one size fits all. We need to have that conversation in terms of what the peculiar needs of the individual would be. Then we can advise on those, advice based on the peculiarity of that individual. Just so we are not giving blanket advices and then people run with it. I think the advice will be more tailored to specific individuals and what they are.
Individual.
Exactly.
Okay, that makes sense. Boss said it says with the headline inflation on the macro snapshot slide, is it indicating that this isn't a good time for investments? And Shasta says, with the current exchange rate on the macro snapshots, what is the risk for EIF and DBF?
Inflation declining, is it a good time for investment? Depending on what your investment universe is really. Um, investment universe really. So like I did mention, your what's it called? Your investment universe, you can have bonds, have money market instruments, have equities. So if all you have in your investment universe are money market instruments and maybe your FDs, then with inflation declining, there's the there's the there's a tendency that the central bank want to cut back on interest rates, and you might be adversely impacted by that. But if you have equities in your investment universe, with lower interest rates, companies are able to get loans at relatively cheaper levels, meaning that they have access to lower borrowing costs, and that will be able to support their growth. And then with growing companies, the companies get to do better, and shareholders within the companies get to benefit from the growth levels in those companies. And so it's to answer the question a bit more directly, it depends on your investment universe, your the assets you have in your portfolio, and typically lower inflation would most likely mean lower interest rates, and your typical fixed income or your money market instruments might declare on the back of that. But having equities in your portfolio would be would be an asset class that would perform in the midst of declining inflation. And is it a good time to invest? Depends on what you're holding. I think now you might as well, depending on what you're holding and what your risk appetite really is, you might decide to want to lock in the interest rates you are getting on your fixed deposits, on your money market instrument, maybe on your bonds, lock them now. And then because you have the view that interest rates might further decline, but then you can also take positions in your equities because you feel that certain companies might benefit of some of these improving macro indicators, and that might be good for you as an equity investor. I think that answers question one. Question two, with the current exchange rate on the macro snapshot, what is the risk for AIF and DBF? I think I touched on what the implications would be for AIF. Companies might have access to more funding. Companies, even from an FX standpoint, you'd observe that a lot of the companies did not do as great when FX jumped, because most of their raw materials were import dependent. They had to face a lot of FX challenges on their book. But with improved FX, much of that would most likely be muted, meaning that the performance of these companies might most likely improve. And we've seen some of that in recent times, more specifically around the consumer goods and perhaps the banking names as well. What does that mean for DBF? For DBF, not so much a direct impact, because for the dollar bond portfolio, the macros, the snapshot that we have on the earlier slides really would not directly impact DBA, but from a global macro standpoint, certain activities might most likely impact the DBF portfolio. But to the question a bit more specifically, not a direct impact, but direct impact to the DBF, but on the AIF, I'd dutifully explained how that would positively impact the EIF portfolios. And any questions? Any further questions?
There are still a number of questions.
Wow.
Olubenga says, if you want to go for balanced risk portfolio, can I mandate to AXA Mansard to spread my money in money markets across the three portfolios as mentioned?
Yeah, most definitely would just require an instruction from you to be able to action on this pattern. Most definitely we can do that. Can reach out to the team at client services at AXA Mansard. We can have that done.
Yeah, absolutely. So we have another message from Ayodeju, which says, for the EIF, is dividend paid yearly only, and also is the reinvestment of dividend automatically done?
So for the EIF, the dividends are paid on a yearly basis, and reinvestment is not automatically done. Reinvestment is paid to the accounts of the unit holders. So if you want to automatically reinvest it, once you get your dividend, you can plow it back into the fund.
Okay. Okay. Eugene says, how quick does the payment made reflect on customers' dashboard?
So once the inflow is made within the stipulated inflow timeline, which is before 2 p.m. on the day you inflow the money, most definitely you get it same day, instantly. But over the weekend, you would get it on the first work day. So if you inflow the money on Tuesday before 2 p.m., you most definitely get it on Tuesday before 2 p.m. Same as every other working day. But for the weekend, you would most definitely get that on the best case, on the worst case by Monday. So instantly.
Okay. All right, we have some kind words here. Olamide, thank you, Progress. Treasure, thank you, Progress. Olisa, thank you, Progress. Taiwo, I'll say it again. How much is the minimum I can add to my MMF and EIF daily?
So for the money market, you can add 5K for the EIF if you can do. Thank you.
Okay. Augustine, would you advise we invest more to mitigate the excessive tax?
Again, this tax question, I think it's coming from a place of maybe we want to dodge it or we want to jump over it. Well, I think I get where it's coming from. But again, the taxes are spread abroad. They're not just income taxes, they're also capital gain tax. So perhaps if you invest and you want to liquidate, some tax might apply. And there are also income taxes as well. So basically it should not just be from mitigating excessive taxes, but investing more. I think we need to speak to you, Augustine P, so that we know what your tax needs, what your tax status is really, so that we can provide a bit more definite strategies and approach to you, so that we are not just shooting blanks in the air, if you get the point.
Thanks, Progress. Okay. Somebody says, okay, I just lost that. Okay, she just given a suggestion. Thank you, Bossedi. Noted. Such invitation in the evenings rather than during weekdays. Thank you. Mama says, I think taxes only apply to investments of 15 million plus. Not sure about that. I don't know what that is.
Yes. Again, she's right, and that's why we would want to have those recommendations on a case-by-case basis, just so that we're able to better advise the clients, so that we're not just shooting blanks in the air, once again.
Okay, thank you, Progress. I think that's to everyone who has asked this question. and clarification and help and advice, you can send but hello, can you hear me? Can you
Yes, yes,
hear
I
me in
can, but I
progress?
think you were breaking for.
Okay,
Yeah, I can
fantastic.
hear you, but I think you were breaking for
For a
for some
moment.
periods.
Yeah, so
Yeah.
I was saying that any if you need advice, you need to clarify some things, you can send an email to clientservices@axamansard.com, and we can have those tailored discussions and the likes. When would this be uploaded on YouTube? Once it is uploaded, it will be shared with you. Thanks for that question. We will upload them on YouTube. Yeah, I don't see any other questions or comments. So I think this is a good time to bring this session to a close. Thank you so much, Progress, for your time, for all the effort and all the energy that went into this. And thank you everyone for joining us. And yeah, I think we can bring this to an end at this point. Thank you so much and enjoy the rest of your day. We'll see you next time. Thank you.
Thank you very much.
All right. Bye-bye.